All right. So Sophie, Casper, floor is yours.
All right, I'll share my slides here. So welcome everybody to this short workshop on angel investing. One thing that I want to say before we get started is I'd like to have people participate. So please feel free to ask questions. I always think there are no dumb questions. The only dumb thing you can do is not ask a question if you have a question. So please speak up. And every now and then I have scheduled some time for discussion so that you can interact and stay with the meeting. So having said that, let's get started with angel investing. So the objectives for today is you'll learn a little bit about startups and angel investing and the whole ecosystem. What are successful returns as an angel investor? And there's more than just financials there. And we'll talk about diversity and impact investing, because that's something that is near and dear to our hearts. So first of all, let's get started with the startups and ecosystem. Now, does anybody have a favorite startup that they want to share with us? A startup that you really like and you want to say, well, this is a startup I like because. Anybody?
Yes, I can. Do you hear me?
Yeah.
Okay. So yeah, I have a startup from India. They are launching a platform for a secondary market for ebooks. So today, if you buy an ebook on Amazon, you can't share it with your friends. So your ebook is bound to your email address or to your computer. And people from, let's say, poorer countries who don't have the same buying power as we have in the Western world, they can't afford just to buy these ebooks. So they got this idea to create with NFT a secondary market for ebooks, which I find quite a nice idea, which would be democratization of education all over the world.
Yeah, that's a nice startup. Anybody else want to share something? Well, we already had a good example, so let's move on.
I can maybe share one, Caspar, that is also going into the field of ed tech. It's Labster. I don't know if you've heard about it. Actually, it was founded by a friend of mine who is a former consultant, but did a lot in the area of education, and basically the idea was to allow students from developing countries, from third world countries, mainly in Africa, to perform various experiments in physics and biology, where actually they don't have access to typical laboratories, to typical science laboratories where you would normally go and you would do like chemistry experiments, for example. And this is super important because basically those students can actually now learn from practical experiences. So it's called Labster, and it's actually a big, now it has become a quite big startup. I think it has like over 30 million funding. So they have passed a couple of rounds already. Not necessarily our focus today, but that's definitely something that is really, I would say, a successful story in the ed tech. And it was, as I said, like founded in Zurich by a bunch of guys, including this Danish friend of mine. So very inspiring one, I would say.
Yeah, interesting. All right, well, let's then take a look. We'll go fairly quickly here. What is a startup? So it's, of course, originally founded in private business, designed to scale very quickly. And if you want to know what that means in terms of growth, to be an interesting investment for angel investors, the startup needs to be able to scale up, ideally with sales over 100 million. And usually start a very small operation with 2 to 3 founders who develop their idea and then seek capital from angels and venture capitals to build out their business. And nowadays, startups, they are a booming ecosystem. So there are a lot of startups. If you look, for instance, in France, at tech impact startups, there are over 700 of them. And they are in sectors like energy, food, circular economy. Startups raised more than 4 billion, and 3 have attained unicorn status with a valuation over 1 billion. And if you look at Switzerland, in the first 3 quarters of 2020, more than 30,000 new companies were founded. And as you can guess already, not all of them are of interest for angel investors, but it's really a type of investment, angel investment, that is becoming more and more important. If you look, for instance, at venture capital funding in Europe, it's really starting to become more and more important also. If you look at the growth per quarter, you can really see that it's been growing from 7 billion to about 28 million. So it's an interesting interesting financial area. Let's take a look at what an angel investor actually is. Anybody wants to make some comment on what they think an angel investor is? Feel free to start up and speak up. If not, we'll just, yeah.
I was going to say, I think it's someone prepared to take a leap of faith and invest very early on.
Yes, true. Yeah. Yeah.
Like in private capital is like one of the type of investors that can actually are investing in the first phases of the growth of a company. No?
Yeah, absolutely. Well, let's take a look. So what is angel investing? So it's typically made by private investors in early or very early stage companies, typically in the form of seed or pre-seed financing, and it comprises of financial contribution in addition to the investment of time, expertise, and connections that the investors provide, typically in exchange for owner equity in the startup. So it's a source of funding for startups after what they call friends and family. So when somebody or 2 or 3 people get together, have an idea, they oftentimes can begin with their own funding, friends and family, but then they look for angel investments, and then afterwards they go to, if everything goes all right, they go to venture capital for larger rounds. So angel investors are usually high net worth individuals. They fund startups at the early stages, and most often it's different from venture capital with their own money, usually in relatively small amounts. And we'll look at that, what that means a little bit later on, in exchange for equity, and what you see a lot nowadays, also a convertible loan. So if you look at who are angel investors, in Switzerland, the legal requirements are fairly loose. You have to be 18 years or older, and you have to pass KYC and AML, so anti-money laundering and know your customer successfully. It is recommended to have a high net worth, but it's not required. So a typical single angel investor makes an investment between 50K and 200K in a company. And it's always recommended to not invest more than 10% of net worth, because angel investments are risky investments. And so you have to be careful there. And you need to reserve some money for follow-up investments. What is often done also are syndicated investments. That's what we at Alpine also work with, where you pool the money. So that basically means that you can get into angel investing with much smaller amounts, typically 5K to 20K per investor. But larger amounts are not unusual, up to 500K. And that allows you to build up a portfolio, and that's important in angel investing. We'll see that also later on. Now a question, now you know a little bit about what angel investors are. Why do people become angel investors? Do you have an idea why do people do this? What drives them? Any ideas, any suggestions?
They believe in the purpose of the startup, and they are looking for returns.
Yeah, very good. They believe in the purpose, and they want to get some return on investment. Yeah. Any other ideas?
They are serial entrepreneurs themselves, and they bring a skill set to the investment. So they're doing an investment plus a contribution of experience and knowledge.
Yeah, Yeah, absolutely. Well, let's take a look at some of the reasons. Oh, screen share, sorry, I think I hit the wrong button. Paused. Screen share, oh, resume share. Okay, so there we go again. Sorry, it was the wrong button. Okay, so the attraction of angel investing. Why do people people become angel investors? Now, first of all, of course, you want to get some return on your investment. So angel investments, and we'll talk about it a little bit later, they want to get high returns. So on average, 2.5 to 3x is not unusual. But there are other reasons. So some people want to be angel investing because they want to invest in a better future, to have some impact for the future. Another reason is diversification of investments. If you invest in very early stage companies, they behave very different from more mature markets. And so you can diversify your portfolio further than would otherwise be possible. Then there's economic growth. Startups are really the growth engine of the economy. So it's very important that people do help young companies. And you can also, one reason can also be to stimulate the inclusion of women and minorities, so diversity and inclusion. Another reason can be interaction with the entrepreneurial community. I have always found it very interesting to work with founders because they are young people, they are enthusiastic, that believe in what they are doing, and they're usually very open to get advice and help. So it's something that gives a lot of satisfaction. And another reason people become angel investors is they can network with other angel investors, and you get to meet people that sometimes you don't get to meet because you can have a different background, and that makes it very interesting to grow your own network. Now let's take a closer look why it makes such an attractive investment. Well, first of all, of course, there's the financial returns. It's important to not forget the financial returns. Let's take a look what we can expect from angel investing. Now, first of all, I want to say again, also in angel investing, there's a need for a diversified investment portfolio. So it's not a good idea to invest in one single company and think that you're going to get rich that way. It's not impossible, but it carries a lot of risk, let's put it that way. So angel investment typically follow a power law distributions. So that means if you look at say 10 to 20 startups, there are a few startups that are very successful, but maybe between 50 or 60% of the startups may need to rethink their business venture. They may get some returns, but it won't be a home run. And there will be some startups that have to fold and give the money back, or maybe just go bankrupt, and you might lose your money. So it's really important to realize you need a diversified portfolio of startups, and it's really recommended to invest in 10 to 12 startup investments so that you can maximize your return to include a big winner or a few winners. And as we saw earlier, if you do that through syndication, then you need less money to get a diversified portfolio. Then it's important to invest in highly scalable startups. So you want to invest in startups that can potentially return up to 10x. So say if you have a friend who wants to start a restaurant, or maybe 2 restaurants in Zurich, that's maybe not such a good investment from an angel investment point of view, because the scale up is simply not there. Now, if we look at angel investment returns, so the studies, academic studies, have shown that the substantial and diversified angel portfolio can provide a yearly return of at least 25%, which is of course very nice. And if one academic study of over 500 angel investors who made more than 3,000 investments, they found a yearly return of 27%. Later was corrected to around 30%. So the returns are really there. If you look at the payoff, the average payoff was 2.7x. So it's between 2.5 and 3x. And the average hold time was about 3.5 years. Now, this is something that is important to realize in angel investing. It's an illiquid investment. So it's not something that you can do and then 3 months later you think, well, you know, I don't believe in it anymore. I want to do something else. If you invest, if you make an angel investment, is really something for the long duration. Average hold time is 3.5 years. I have made angel investments that returned money that had an exit in about a year, but that's quite unusual. Sometimes you need to hold your investment for 6, 7, or 8 years. So it's not something for really short term. Now, if you look at how the whole ecosystem for startup works, is you typically have a pre-seed funding with a funding amount of, say, between 50K to 250K, and those are investors, incubators. If they, well, not necessarily, but usually you would like to get to a minimum viable product, an MVP, for duration maybe 1 to 3 months. Valuation of 1 to 3 million and a runway of 3 to 9 months. Now, if you then go to the next phase, seed funding, that's where angel investors and sometimes institutional investors that do very early stage investing come in. There, the funding amount is, say, between 500K and 3 million. And you can see they want to have several investors who can join together to get to that amount. The valuation is maybe between 5 and 15 million, runway maybe 12 to 18 months. Now, all these numbers are averages, right? So you see outliers, that's not unusual there. Now, if you look at the whole venture capital area, just to get an idea of where angel investment stands. So angel investors typically can contribute pre-seed or seed round. If you then go to round A, assuming that the company is doing well, everything is going according to plan. Investments are becoming a little bit bigger, so 3 million to 10 million. Then in round B, you can say maybe 5 million to 25 million. Round C, investments can be 10 million to 100 million. And later rounds, they can go up to $1 billion, in very successful type of unicorn startups. So that's basically how the venture capital rounds look.
I have a question on the
Yes.
previous slide. So these numbers are the valuation of the companies, or how much they ask for?
No, this is the investment.
Okay, so this is what they are, the funding that they ask.
The funding that they ask, exactly, yes.
Okay,
yes,
and the difference between round A and B is, or C, is the amount that they ask. You can't ask in round A for 20 million, or is not usual, or?
It's very unusual. It sometimes happens. I mean, these are just, guidelines in a way, just to get you an idea what average things are. You can ask for more, but we'll see a little bit later. And it's a good question. With the valuation comes also what do you get for it, right? A certain part of the company. And if you ask for a lot of money in round A, that probably would mean that you have to give a lot of money, a lot of the company away, which is not such a good idea at such an early stage.
Okay, thank you.
Yeah, so we can take a look at the next slide that gives you a little bit an idea. So at each round, there's dilution, right? So you start out, you get a certain percentage of the company for the investment that you make. But once at next rounds, your percentage ownership of the company decreases. So you get less percentage as the company grows. But then the reason why you get this dilution is you get a smaller slice, but the pie becomes much bigger. So that means your piece becomes more valuable, right? So you make an investment, say at 50K, the company goes on. You start maybe with 5% of the company, but as the company goes on, maybe you only have 1% of the company, but the value of this 50K might have been grown to 500K if you're lucky, you made a good investment. So if you look at the ownership that typically investors require at the time of funding, at seed or angel funding, it's typically between 5 and 20% of the company. Round A is a little bit bigger, so and that's typically venture capital money requires 20% to 35% of the company. Then Series B maybe between 10% and 20%, and then at later rounds it's between 5% or 15%. So Series A basically has the biggest ask in terms of the percentage of the company.
And what is the difference between, or when does private equity company comes into play? So this is all VC, early stage?
Yeah, so the seed or angel funding, typically venture capital comes in a little bit later. And the reason behind that is that a venture capitalist usually raises a certain amount of money. Say he raises 50 million or 100 million. Once that money is raised, he doesn't want to put it on the bank. He has to invest it. And so if he has to invest, 50 million in little chunks of 50K, it becomes impossible. So he's not interested in those small amounts. He wants to be able to invest a significant chunk of that money because it needs to be invested in a company. He can't just say, well, sorry to his investors, it's in the bank and you get 1% on that money. So venture capitalists want to invest larger amounts. That's basically the reasoning behind it.
If I can ask something on that, is every step of fundraising, they establish an amount of money they need to achieve the next step. And if you have, as Gaspar just said, if you raise too much, then it's not good because you don't have use for that money because it's too early. And so it's every step at its own, I would say, range of, fundraising.
Yeah, you can see in a way the whole growth of a startup is in a way from an investment point of view, de-risking the business, right? In the beginning, there's an idea, but who knows whether it's going to work? Is the market there? Is the product good? And then you ask a little bit of money, as little as possible from a founder's point of view, to de-risk that, to maybe develop a prototype. And then you can say, okay, this is okay product. And then you can ask a little bit more to see if there's a little bit of market traction. If you straight away ask for all the money that you need, investors are not going to be interested because it's too risky. Right, so it's every step of the investment process is in a way de-risking of the company, and that's why if you invest at later stage, it becomes less and less risky because more and more has been proven in terms of product, market traction, and so on. Whether the team is good, whether they can hire, and so on. So the early investors, they take more risk. They can get significant return. Because of that, yeah. Right.
Sorry, I have just another question.
Yes, yes, go ahead.
Related, and very often, I mean, I was wondering what's the landscape in Switzerland, for example, because I've heard sometimes that I mean, you have these first rounds, but do you also have round C's here, or how does it look like?
You do, but yeah, that's a good question. In a way, unfortunately, Europe is lagging behind the US in terms of large venture capitalist funding. So really successful startups, they often they move they move to the US because there's more money available. So there are venture capital funds, and there is enough money to do some investments, but Europe is lagging in terms of in the whole venture capital world with respect to the US. There is simply more venture capital money there. So it does happen that some of the successful startups, they move to the US.
Does that mean that there is a need here, or because
very
absolutely. Often we have in Europe, I mean, every like a successful company now is at some point moving, so that I would just my first impression is that there is like a real need here for more.
There is absolutely capital. there is a real need, and I think that's also realized by the politicians. So there is a lot of interest in Switzerland, but also at European level to try to grow the venture capital business, because there are a lot of good ideas in Europe, but some of the best ideas, they get snatched up by the US. It's just the unfortunate truth. And to a certain degree, that's the reason is also that many times venture capitalists are are used to be founders of startups, and they are very successful, and they are in the US, and they make a lot of money, and then they become venture capital. So the venture capital is a little bit of a circle in a way, right? So once you become successful, you can reinvest. So and Europe is a little bit lagging. So yeah, there is a real need for more, but there is politicians realize that because for an economic point of view, economic growth, it's very important that the successful startups don't go to the US but stay in Europe or in Switzerland.
And you say that good startups go to US because there is more money, because just the population is bigger, so there are more people who are ready to invest, or because people who invest are ready to invest more money than in Switzerland?
I think it has to do maybe with the latter, in the sense that venture capital investments are risky, and there is a little bit more appetite, I think, in the US to invest money, because I think in the US there is more acceptance of failure. Right? If you fail in the US, it's not seen as a bad thing. You know, companies do fail. You do sometimes not make it, and people actually realize that people who go through that phase of failure learn so much that for the next round they are very interesting for investors. Whereas in Europe, sometimes people have a tendency that if you fail, then you're a failure, right? So they don't get the second round of money. So it's a little bit a different.
On to that, so I absolutely agree to what you said about the failure culture, but I think also I would say that in the US, especially from what I've seen in Silicon Valley at Stanford, where I studied, there is really I would say a kind of ecosystem that is just helping the entrepreneurs also to go in collaboration with the universities, with other companies. So I would say that it's, yes, the culture of failure is accepted, but you are also being encouraged, and I would say that you definitely get a bigger support system and a bigger network than I think you would get in Europe. However, I have to say that the Swiss Silicon Valley, in that sense, with the ETH and EPFL, is for sure something that is quite, I would say, innovative and quite supportive on the government side, but also on the university aspect, right? But I was just really impressed by the level of support from US universities and technology companies as well, for example.
Yeah, absolutely. That's absolutely true. Yeah.
And
yeah, I agree with that.
They've been doing that, as you say, Gaspar. They've been doing, especially venture capitalists, for a few decades already.
Oh yeah, it's very well established.
Yeah, if you fail, that doesn't mean you're a failure. Therefore, okay, fine, maybe it's too early for the market or whatever happens, but you get another chance. Definitely, if your product is good the next time around, and they really have, honestly, a few decades, well, they are a few decades ahead of us, so they know how to do it. Here, the appetite is developing, and that's why actually we decided to start, Alpine, because there's really the sense of angel investment is really seen as an alternative investment now, and is part of your portfolio construction as I would say, retail investor. So this is so we're getting there, but yeah, the States, it's and we have a lot of demand or offer from the States every day, from just LinkedIn, and they're really scouting a lot and those kind of things. But so let's maybe move forward.
Absolutely, yeah.
We're not even half of it.
Yeah, so let's take a look at the investment process. How does that go? Esther, do you want to talk a little bit on this? Being mindful of the timing.
Just very quickly, and I would suggest, if it's fine, that we speak really a little bit more about the prospecting, analyzing, and then I think, Gaspar, you will anyway speak about the closing later. So quickly, as Gaspar has explained, there is really a proper process behind the angel investing, and actually there are like three main steps that we can see. The first one being really the prospecting, which means identifying the different startups that will then be a target in that sense. So it also means attending, for example, pitch events. This is something that we at Alpine are doing on a regular basis, and establishing what we call like the deal flow, looking at different a startup. So it's really basically about finding your potential target or your opportunity in that sense, right? And obviously in those pitch events, or when you listen to a pitch that is, let's say 10-15 minutes, you will gather a little bit of a, I don't want to say gut feeling, but you will get a little bit of a feeling about the startup, its business model, its market, the potential, the team. And then speak about it in a second, about the criteria that you should look at. The second part is really the analysis. This is basically where you would go deeper into the analysis of the startup. You would start basically doing a due diligence in a proper deal room, which means that you would have access to much deeper understanding of the startup. You would be understanding its business model much more in detail, analyzing the competition, looking at its financials, looking really at the different type of risks, whether it has been considering those risks. So you would really do kind of, yeah, I mean, as the word says, a proper due diligence over a couple of weeks as soon as possible, obviously, so that you really have a good understanding of the risks and also of the upsides that are associated with the startup, right? And then once the due diligence has been done, then you end up with the valuation and the deal memo. The valuation obviously giving also a little bit of a perspective, of an outlook about how much the startup is actually worth now and also in the future. And it's obviously very important, especially as you will then be investing your money, and you need to understand what are the financial implications, how much kind of shares can you get from the startup in exchange for your investment, right? So this is really the prospecting and analysis. And before Caspar talks about the closing, I would suggest that we go to the next slide and discuss what are the key questions that you should answer when you start evaluating the company, when you listen to a startup pitch. Maybe pausing here for a second. If you had to think of what are the most important points when you have to evaluate a new startup, what would it be from your perspective, just spontaneously?
Let's say the purpose of the business idea, the uniqueness. So, you know, how competitive are they in the market, and the team.
And the team, yes. Great. Any other ideas?
I would say market potential, the size of the target market, and therefore that dictates how scalable the operation is. As well, I agree about team. I think the team is very core, yeah. Super.
But then let's maybe take a look at a structured approach to those kind of due diligence guidelines, as we've called it, but actually the very good points already that both of you have mentioned around team scalability, business model. So let's start with those points, right? And then it's a quite long list. I will just give you a couple of ideas, maybe explanations around it. And please bear in mind that actually when you listen to a pitch in 15 minutes and you do a little bit of homework, obviously you will not be able to answer all those questions. This is really kind of requires more exhaustive research, and this is something that you would do at a second stage after the prospecting in really actually the due diligence per se. So what is the first point that you have to ask yourself? The problem, right? Is the business addressing a clearly defined problem or a clearly defined challenge? So because, for example, here we are speaking about impact investing, it means that the startup should clearly be addressing a problem that is linked to the UN SDGs, right? So the UN Sustainable Development Goals. Remember just the 17 goals defined by the United Nations around, for example, ending poverty, hunger, increase access to quality education, clean water, etc. Right? So 17 of those goals. So for us, for example, in impact investing, the purpose of this startup should really be linked to one of those UN development goals. This is really something important. Also, something that is really important here is the scalability and the size of the problem, right? Like how relevant is this problem? Linked to the problem comes, of course, the solution. So is it really clear when you listen to the pitch or you look at the due diligence documents, whether there is a clear solution? Is this really clear? Is it a well-structured product or a service? Does the founder team have experience in solving the problem? Or are we just talking about good intentions? If we speak, for example, about something that is around clean water or climate change, then ideally you would have a CTO or a CEO that has really a technology background, engineering or a climate scientist background that can actually talk about the product and the solution, right? It sounds basic, but actually it's very, very important. Also, one important aspect that you've already mentioned is the scalability of the solution. Are we talking about a solution that is maybe very capital intensive and actually only applies to the Swiss market, which is fairly spoken as rather small market? So you would want to look at solutions that can actually be expanded in the whole world, or at least within Europe, right? Which is very important. And here also plays a big part is the competition. So maybe the problem is well known, there is a market for it, the solution also sounds great, but actually there are already a lot of competitors in that market. And maybe the solution that the startup is offering is not even better from a, for example, technology or product or marketing perspective, or maybe it's more expensive than products that are already existing, right? So I think this is super important that you clearly understand here and compare and look also at the competition. And this goes actually to the third point, which is around the market. As I already mentioned, the size of the market, the size of the potential customers is very important. Also, how competitive is this market? The classic 5 forces of Porter, right? Is there a low entry barrier into that market, which means that the product can be replicated very, very easily, which would obviously not be ideal. And also, how dynamic is the market in the sense of why now? Why is this startup coming up with this specific product or service now? Is it because I'm just thinking there is a change in regulations, there is something, there is geopolitical change, which really kind of has an urge, is putting a pressure, is really why this issue has become an urgent solution to be solved. So maybe that can explain also why this is the right moment for a startup to enter the market. It sounds really simple things, but actually you might have a great idea, but it might not be the right timing to introduce that idea, that product into the market. And then obviously you also need to understand what is the go-to-market plan, just to conclude on that. So how will you enter the market within the next 6 months, 1 year, and then how do you plan to scale and expand? Yeah, let's go to the next slide, Kaspar, thanks. So now we've spoken about the solution, the product, the market. And what about then the business model, right? So here it's really about understanding the viability of the financial plan, which is really very important, because at the end of the day, the startup is asking for money and it will be accountable towards investors. So what are the projections in the business model? What are the assumptions behind the business model? You need to understand a little bit of valuation, of net present value calculations, of IRR, for example. And you need to also understand at which point the cash flow of the startup is going to be positive, after how many years will you actually get your investment back, right? And these things actually can't really be ignored by the startup that is presenting its business model. Couple of things around value creation. I think I've already mentioned most of them. I think maybe here something that is important around value creation is to have that at a certain point the startup should have some KPIs, some key performance indicators, how it does want to implement some of the measures, how it does want to sustainably create value. Is it embedded into an ecosystem, for example, an ecosystem of early adopters, an ecosystem of support? I think this is also something, it's not the most important point, I would say, but it's also something to consider. And last but not least, what personally for me is really the key aspect, and I think you also mentioned it, is really about the team, right? You can have a great product, great business model on paper, but then if you don't have a team that is driven enough, that has, I would say, good mix of skills in terms of capabilities, of skills, of experience, which is really, really important, and dedicated people who actually do have time, not just aside 10% of their time next to a job or family life, but who are really dedicated into making this enterprise a success and to really believe in that as their own baby, and for whom this is really a mission. I think this is really, I would say, the biggest key to success, right? And also maybe just to add on the team part, I think it's also very important that that the startup is, I would say the founder is a person that has leadership skills, can retain talent, but is also open to advice, right? Because you will want a founder that is really, has ideally an advisory board or a network of people, of experts, of SMEs, etc., that they can rely upon, especially if it's something a little bit more technological or investment or tech, in the tech area, right? And then, yeah, as I said, last but not least, of course, how much money does actually just the company need? What are we talking about? Is it a company that has already raised money? What is the prior valuation? What is the current valuation? Obviously, a startup that has already successfully passed our first due diligence beyond friends and family will likely to be, I would say, more attractive, because you have a certain higher level of confidence, because you will see that some other people have already invested into that startup. So there is a higher likelihood that it is actually going to prosper, as it just gives you a better, in that sense, it just gives you a better feeling. So yeah, that was it around the due diligence factors. Any questions maybe, or any reactions, or does it all make sense to you? Is it intuitive?
Well, if there's no questions, let's take a quick look at what are key success factors for a startup. And it turns out that the timing is maybe the most important one. And that, in a sense, may make sense, because the timing has to be perfect for a startup. You know, a larger company has the financial resources to wait out a market. If it takes 2 years before their product gets traction, it's okay, they can take that loss. But for a startup, it's too long, right? So the timing is really important. Why now is always an important question to ask. Then the next important issue is team and execution. So the team is very important. Why is the team important? Because sometimes the product needs to be redefined. The original idea that they have may sound great, but maybe the market doesn't buy it, and it has to be changed. And then execution. So to actually get the product out in time to the market is really important. So what some people think that the idea is really the most important part of a startup, it's really only maybe third place. So a good idea obviously is important, but not so important as some people say. Then the business model is important. Finally, funding is not that important. A good startup can get by with mediocre funding. Now, just an idea. Now you know a little bit about what angel investments are. Any idea what angel investors do after the investment? So you have made, transferred the money to the startup. That's it, right? So what do you do now? Any ideas?
I mean, depending on how much you've invested, you would like to be part of, the ongoing discussions on kind of how the business is being managed and how they're growing, if it's going to plan. And yeah, obviously depends on how much of the company you own. Not
yeah, sure.
Small percentage, you wouldn't get that access. But I think for an active angel investor, it would be important to, promote the company even, and help them grow and advise them and give them the network that you have.
Yeah, excellent. Yeah, those are all good points.
Yeah.
Well, let's take a look. So what's the role of angels after the deal, right? Well, of course, source of capital is important, right? That's what startups need to grow capital. But oftentimes angel investors play a more important role. And sometimes angel investors are more appreciated for what they bring on top of the money, So the money sometimes is secondary. So what can an angel do? If the investment is large enough, they can sit on the board, become part of the board or an advisory member of the company. Angels can contribute their network, so open up their network to issues that the company runs into. And that's something that is oftentimes very much appreciated with startups. Startups that I have invested in as an angel are always open to discussion, and usually you get a good relationship with the founder. And if you have issues, they can contact you, and sometimes you can contact them. So network is very important. Sometimes recruitment is important. The startup needs to grow, needs to find people for the right positions. And maybe in your network, you have several people who might be a good fit there. Then there's something was mentioned also. You can do some PR and marketing. Tell about your startup because you probably believe in their goal, and you can help them to become a little bit more well-known. And finally, sometimes you can contribute as a technical expert if you are really in the field that the startup is working in. is something that can be very valuable because you just have more experience in that area then. So let's take a look at impact investing and what that all entails, because that's something that's also near and dear to our heart. So first of all, from a sort of higher point of view, impact investing basically means investing according to your values, right? With the intention to generate positive and measurable social and environmental impact alongside a financial return. So the impact investment market provides capital, to address some of the most challenging problems in the world. Renewable energy, sustainable agriculture, conservation, microfinance, more accessible education, healthcare. So all those things are really important. And as an impact angel investor, you can have an impact there. Now, it used to be the idea that it was a trade-off, right? Either you had to go for financial returns or you did something that you actually really believed in. But both of them, maybe not so good, that's a good idea. But nowadays it's been found out by research that you can achieve both together. You can make investments that help the world solve some of the most pressing problems, and at the same time make a good return on your investment, which is something that's sometimes surprising to a lot of people. So let's take a look, different flavors of impact investing. So you can use ESG, environmental, social, and governance aspects, in addition to financial analysis, and it sometimes can actually help you get better return on your investment. For example, change from petrol-based energy to clean energy on the long term can result in above average financial returns. Now, if you then take another step at SRI, socially responsible investing, there you follow your heart even more, and you maybe want to focus on specific areas that you really believe in. That can be positive in sense renewable energy or agriculture, something that has to do with water for people that don't have access to clean water. But it can also be negative in the sense saying, I don't want to invest in certain areas. You can say, I don't want to invest in weapons manufacturer, or I don't want to invest in gambling because that's not according to my ethical values. And so what's the impact on returns? Sometimes impact investors are willing to accept lower than market risk adjusted returns to achieve specific ethical goals, right? So closer to capital preservation. For instance, you can say, well, cleanup of plastic waste in the ocean is really important for me. I believe I want to create a future for my children. And this is so important that I am willing to accept less financial returns. But that's all a very personal choice, right? So these are all personal choices, what you believe in, what makes sense for you. Now, just coming back to the myth of lower returns, right? So there's actually a really large body of academic analysis that shows that if you use impact factors above and beyond financial risk, it can actually contribute to lowering your portfolio risk, and improve the risk-adjusted profile of your portfolio. So a meta study done in 2015 shows that in 90% of the cases, ESG factors have a positive or neutral impact on financial returns, and sustainable funds. They basically provide returns in line with comparable traditional funds. So that basically shows us that you can follow what you believe in, what your heart tells you, what's ethical for you, and at the same time have good financial returns. Now, next thing that's also near and dear to our hearts. Any questions?
Sorry to interrupt. I just wanted to notify that we have about 5 minutes left. So if you'd like to use it more for discussion and question, feel free, but otherwise you can also continue.
Well, I'll quickly go through diversity and inclusion. Basically, what you can see in VC funding, it's only a very small percentage that goes to founding teams with at least one woman on the team. And if you look at some quick investments, you can see here the male-only startups. They benefit most from VC investments. And there's a lot to be improved there in terms of both on the investment side. The investment side is often still dominated also by males, but also on the startup side. And there is a lot to be said of investing in diversity, right? Because companies led by women are more capital efficient, and they sometimes get higher revenues. So quickly going through here, we don't have that much time, but Sophie, if you want to talk a little bit, or we can leave it open to discussion.
Yeah, it's just we just wanted to introduce a bit Alpine, especially now you have a better idea of what is how to be a business angel and so on. But I think it's better to have questions. 2 words: we just an association. We are non-profit. You know our pillars are technology, UN SDGs, and diversity. And we have set up everything in Switzerland in a very transparent way with our partner Leva. Everything is on our website if you want to know more. What is more important to know is there's a community, the sense of community, and when you want to start investing, this is actually in startup is very it's very important to be part of that community, to be able to ask your questions, and to invest together. So this is what we are here today. It's not to sell our company, it's really to give you a sense of what it means to be a business angel, and the how to, and to yeah, maybe to have more questions on the process, the finances, and the, you know, how that works. I think it's better to have few questions. You have 3 minutes. That's it. That I don't. I'm not going to talk too long.
Yeah, any questions that you have that you would like to see answered?
And what about the chat? The chat. Oh, that's a form. Yes.
Can I just ask, since you're called Alpine Angel Investors, are you only interested in investing in Swiss-based companies, or do you look further afield?
No, we are. No, our focus right now is more European, but we can cater to the, you know, to even the US citizens. No, yeah, it needs to be a bit more tailored with our financial platform, but that shouldn't be a problem. And I think Europe, there's already quite a lot to do. And there are other, we work as well with partners. We know other business angel platforms throughout Europe, and this is a good way to net. Literally, it's like knitting the whole network of men and women investors. So yeah, we do appreciate that.
I see.
Yeah, 1 minute. What I'm going to say is on Monday morning, 8 o'clock, I have a coffee, morning coffee with with the ladies that we had, you know, in a different group, and sustainability group focus. And if you want to participate, maybe Town, you can, you know, then it would be a good follow-up, because I don't think we have enough time right now.
Of course, I mean, you know, Sophie and Casper also generously offered to stay a bit past the hour. So I think for those who have some questions, feel free to stay. Just wanted to point out that Paula also has a question.
Yeah, thank you. Thank you for the nice presentation. I have a general question, because while you were talking, it seemed like you were describing a very structured process. But yeah, at this point, my question will really be, how do we get to know, you know, new companies that need for angel investors and venture capitalists? I mean, I don't know, in terms of newsletters or events, yeah, these kind of things. How can we get informed about them if we want to invest?
There's several ways. What we do is we basically get in touch with the incubators. So we talk and partner with incubators. Then there are several business plan competitions, which is also an interesting source of good startups. So the ecosystem in Switzerland is fairly mature. There's a lot of money that's being invested also in networking, business plan competitions, ranking of startups. There's every year, and there's a document that comes out that tells a little bit about what the best performing startups in Switzerland are. But to find startups is that's part of what we focus on to get some kind of a deal flow going. So that means we try to find interesting companies, and once you get known a little bit, companies find you also, right? Because they are looking for money, right? So since we have specific goals, companies who share the goals with us sometimes contact us.
Mm-hmm.
And we do pre-screening when we organize a pitch event, and that's, as you said, it's more or less it's the same thing everywhere. You already have a pre-screening. You chat to the startups, to the entrepreneur to see where they are, what they the scalability, the vision, the mission, diversity. Diversity is a mindset. It's yeah. And especially at that stage, it can be just all men, but they have a sense of diversity. So it's good, it's okay. Or all women, but same. So no.
Okay, thank you.
Just before everyone leaves, I just wanted to point out in the chat that I posted a Google form. If you have time, then it would be really great to get some feedback on how you liked the session and what you liked in particular. Otherwise, feel free to just shoot us an email. And then Sophie also shared information of her contact numbers if you're, not numbers, email, if you're interested in the coffee discussion. And otherwise, there was a question, Sophie, for you guys, whether you'd be able to share the slides after the session.
Yes,
sure, yeah.
Yeah,
we can do that.
Yeah. And so do you have any other more questions? Or
so what time is Monday, the coffee?
Oh, sorry, 8 o'clock.
It's 8, okay.
Yes, I look, bear with me. I think I already organized the no, I haven't organized yet the Zoom. So yeah, I'm sorry. So you really have to send me a message so I can send you the Zoom.
Okay, thank you.
Another group of women as well, focused on sustainability. A lot, some startups, some financial, some it's a very, very interesting group for you as well as women in sustainable finance. It could be actually another group to chat with, and it's only women.
Okay, thank you. And in general, is there like a matching platform? I mean, the question I dropped off because my internet was weak. When startups are looking for money, I mean, they know, their area of expertise, but is there any in Switzerland, any matching platform or not yet? When you say, I like to invest in these industries, and then the startups can, where startups and investors would see each other.
You do have some. Actually, they start up themselves. I've been contacted by 2 or 3 of them. They're themselves actually startups. I think one is interesting is 60, but 60 doesn't. It's a matching, as you said, pure matching. And in Switzerland, they have become the biggest one. And they do have a lot of demands from European startups as well to be part of their process. So I think out of my mind, I think they have like 2,000 startups per year. It's enormous. And then they do actually the matching. They organize pitch sessions and competition. They have different things, but they don't go. It's up to the group to start the due diligence process and to invest. So, and they don't provide that. So it's purely matching at that stage. Yeah.
Sorry, again, what is it called? SICTIC, did you say?
SICTIC.
SICTIC. What we said is, you know,
okay, yes, I know.
Yeah, and that's why my last point was really on community. It's not. It would be great if you all become members, super active, investing a lot with us only, but we as a diversification of your portfolio, like that alternative investment as a business angel is. You should, you know, have a look at other business angel as well. A lot are specialized. It's really up to you to see what is your interest. But it's because you need to have several investments. That's really key. To have to invest one or two, it's just not, unless you invest big, and then you know it's different. It's a different story. But that's to have a bit look around of what you want and where, what kind of industry or what kind of UN SDG you want to invest. It's it makes more sense in your portfolio.
Are there any remaining questions, comments?
I have one question. Esther mentioned before that there is a big support from the universities for the startup. In which sense do they support in terms of skills and knowledge?
So I would say different things. So on the one hand, yes, for sure, there is the skills and the knowledge, the cooperation with some chairs, with some professors, but there are also like grants that actually are being made available. I know it for ETH, but then I really know that it's really the case for the US as well, or where you would actually have like, I think for INSEAD, they also, and also in the US, they have like centers for entrepreneurship, where you can actually, like young entrepreneurs can really basically work there. So it's, you know, the physical space kind of that is being made available, for example, at the Stanford campus, and where you actually really get this coaching and advice from professors, or also from companies or entrepreneurs who have already, I would say, like been successful, basically, right? So you get, yeah, it's kind of a platform, an ecosystem, knowledge, grants, so different type of things, access to researchers, which is obviously very important, especially if you work in the area of you know, like a technological or scientist research. So I realized that my camera was turned on. Sorry. So yeah, to your question.
Okay, thank you.
Makes sense. As well, you do, for example, I know in Switzerland, a lot of all the major universities, which are actually very good here, they have incubators or an innovation department. I was actually going to town earlier that we are being invited to St. Gallen and to the entrepreneurial finance class to organize a workshop, meaning for the whole session, not for a whole session of but for the whole duration of the course. So we have several spots. They're going to have a whole reporting to do and due diligence, those kind of things. And that is quite common. For IMD, SEM, EPFL, Gaspard, they have an innovation, I can't remember, some kind of...
The EPFL has an innovation park where startups can rent space. It's right next to the campus. And they have an incubator also. And what also happens is that oftentimes people who want to start a company have studied or maybe did a PhD at EPFL or ETH. And there is some kind of sharing of patents. So if there are patents, they license them for relatively good terms and so on. So there's a lot of cooperation in that sense.
Yeah, Sam Eteha has a good one as a innovation, I think, innovation incubator. And you see a lot of spin-off actually from ETH in Zurich. So, and I know in France as well, London, you know, all the major universities in Europe are trying to catch up. I don't think they have the same, I see Esther smiling, I don't think they have the same kind of budget, but it's, we have a lot of gray sales. So,
They do. I think for Switzerland, yes, for sure. For France or for the UK, not so much. So there,
Yes.
But again, it's not about blaming and shaming or discussing which country is the more innovative. Definitely Switzerland is one of the most innovative countries, but obviously nothing compared to the US yet.
Yeah.
And the Crunchbase database, it's US specific, or I still haven't explored it, or is it worldwide? Or is there any database for startups for Switzerland? Where would I find it? Is there?
That's yeah.
Crunch is more focused on the US. I don't. There are some publications that focus specifically on Switzerland, but it's a much smaller market, right? So there's less, simply less
Sophistication. Yeah.
The Federation has on their official website. If you type industries and you just click around the industries and those kind of things, you can find some data. They do.
Where is it? You say?
I can't remember, but if you type industries, it's actually
industries. Industries. Yeah, I know.
Industries is part of the federation. It's something official it's sponsored by the federation. I don't know exactly.
Yeah.
So then you can get by clicking and researching around that, on the federation. But you have, if you're really interested, you have as well the European Business Angel Network, which has been supported by the EU, EBAN. And that there you can find as well some more information, indication. You have actually as well in Switzerland or in Europe. If you just Google a little bit, plenty of newsletters or magazines that. I don't know. I have so many actually.
Yeah, Switzerland brings out the yearly report. I don't know if you can see it here.
Yes, I read this one. Yeah.
The Swiss Venture Capital report that is brought out yearly. That gives a little bit of information.
For example, you have Venture Lab. I'm actually trying to open. I can write. Okay, there are one I like is SIFT here. Then you have Venture Lab. My memory is good. There's something called Tech EU. I don't know what. I'm not too sure. What is that one? Yeah, that one is not bad actually. That one is really more Europe. It's EU. That's the email. Startup. Have a look. After that you need to register and those kind of things. SIFT is actually quite good. I like it as well. And more, and you have Venture Lab. Venture Lab is good. Yeah. Well, that is if you're really interested. There's already quite. You already have some information there on a regular basis.
Thank you very much.
Well, perhaps out of time reason, maybe we could sort of close it off here.